This podcast is sponsored by AXA Farm Insurance. AXA offers tailored cover to fit your unique needs, whether it's public liability or protection for your family home, outbuildings or farm vehicles. Based in Athlone, the AXA Farm team of agri-specialists and regional managers work together to ensure you receive the seamless support you need. Switching to AXA is easy thanks to an innovative online service that enables you to quickly and easily find the best cover for your needs. For more information, head to axa.ie. AXA Insurance Stack is regulated by the Central Bank of Ireland. Thanks for listening, and we hope you enjoy the show.
Hello and welcome to AgriFocus, brought to you by Agriland and AXA Insurance. I'm Stella Meehan and I'm joined today by EY Ireland tax partner Alison McHugh to talk about tax changes, especially in terms of Agri Relief following the announcement of Budget 2025. Now, the Finance Bill provided for the extension of stock reliefs such as general stock relief, young trained farmer stock relief, and registered farm partnerships until the end of December 2027. There was also an increase in the flat rate scheme for unregistered farmers from 4.8% to 5.1% starting on the 1st of January next. But tax legislation provides for relief from capital acquisitions tax, that's CAT, for gifts and inheritance of agricultural property where certain conditions are met. Well, what it means is basically that for reducing the CAT purposes, the market value of qualifying assets by 90%. So that's significant. And to qualify for the relief, a number of conditions must be met by the beneficiary. One condition is that the active farmer test, which requires the beneficiary to farm the agricultural property or lease it to an individual who farms the property for at least 6 years following the gift of inheritance. Now, there is a transitional period and we'll explain that in a little bit of detail shortly, but I'm going to go to Alison McHugh from EY now, and thanks for joining us, Alison, to kind of work through, I suppose, the detail of this. Can you firstly explain what capital acquisitions tax is and who it applies to?
Sure. Hi, Stella. So capital acquisitions tax, as you mentioned, is our gift and inheritance tax regime. So broadly, CAT, as we say, shorten it down to, applies to any gift or inheritance in the following three scenarios. So where either the disponer, which is the person making the gift or inheritance, is Irish tax resident at the time of making the gift or at the time of death in the case of an inheritance. The person receiving the gift or inheritance is Irish tax resident or a gift of Irish situate property. So it's a residence test for the disponer and the beneficiary, but also Irish situate property will always be within the charged Irish gift or inheritance tax. So the current rate of CAT is 33%. And in the recent budget, the thresholds were increased. So broadly, we have three thresholds of which this amount is free from CAT. So the Class A threshold, which broadly applies to gifts or inheritances that children receive from parents, has been increased from 335,000 to 400,000. So that means that the first 400,000 of gifts or inheritances that children receive from their parents is tax-free. But it is important to note that's a cumulative threshold since 1991. So it's necessary to aggregate all gifts or inheritances. So for example, if you received €50,000 from your parents 10 years ago and now you're receiving a further benefit, you have to take that 50,000 in. We do have our small gift exemption of €3,000 each year that somebody can receive from somebody else, and they're not included in aggregating this threshold. We then have a Class B threshold, which is broadly for all other blood relatives, and that is €40,000 increased from 32,500 in the budget. And then your Class C threshold is really a catch-all for everybody else who's not in the A and B threshold, and that is a threshold of €20,000 per annum.
Okay, and is that for people then who may not be blood related?
Exactly.
Okay.
Yeah.
And in terms then of the thresholds for the CAT and Agri Relief, so how does Agri Relief factor into what you have to pay there for the capital acquisitions?
Sure. So first of all, if somebody receives a gift of agricultural property we need to look to see if they satisfy the conditions to qualify for agricultural relief, which I'll discuss now in a moment. If that is the case, they can then reduce the market value of their gift by 90% in order to calculate the taxable value. So, and then you take off your threshold. So, for example, if somebody gifted agricultural property to somebody and all of the conditions for agricultural relief were met, and say that land was worth €1 million, well, the value of it for tax purposes would only be 100,000 because it would be reduced by 90%. So if you have a parent giving a gift of land to a child, for example, that effectively means that €4 million worth of land could potentially go tax-free, because you'd have 4 million of land. If you meet all the conditions for agricultural relief, that will reduce the taxable value to 400,000. And that is the current threshold announced in the recent budget.
Provided you haven't received any gift prior to that, and that is your first gift.
Exactly. If you've received any prior gifts, as mentioned, you have to aggregate. So therefore you that wouldn't come into play. Obviously, you still have your small gift exemption that could come off that as well. So then I suppose, what are the conditions for agricultural relief? So there was always a number of conditions for beneficiaries. That's the person receiving the gift. And a lot of that is unchanged in the new finance bill changes. Most of the changes really are around the disponer, or the person making the gift. Probably good just to recap on it all, first of all. So for the beneficiary, that's the person receiving the gift. So agricultural relief applies to a gift of agricultural property. So that can include farmland, but it can also include any other agricultural property associated with that. So plant and machinery, or
a farmhouse.
Exactly. Now, there are I suppose rules around farmhouse. It really has to be going with the agricultural land, and it has to be meet certain conditions. But broadly, that can apply too. So we then look at what are the conditions for the beneficiary. So the beneficiary, which is the person receiving the gift, they must be an active farmer. And there are actually two tests for the beneficiary. One is that they're either actively farming the land, and those conditions have been tweaked slightly in the new finance bill changes. But broadly, they're either actively farming the land themselves with a view to realising a profit, or they're leasing the land to an active farmer who is actively farming the land. And under the new finance bill changes, there can be a mix of both. And that is just to allow flexibility for people who are genuinely carrying on a farming trade, but maybe, they have 100 acres and 50 they're farming themselves and 50 they're leasing to somebody who is an active farmer. The second test for the beneficiary is that 80% of their assets after the gift or inheritance has to constitute agricultural property. So, for example, if you were to receive a gift of farmland, when you take the value of the farmland you received plus the value of all of your other assets, over 80% or 80% at least of your total assets have to be in farmland. The only debt you can take off in calculating that 80% test is a mortgage on your main home. So when you're looking at the value of your main home, you can take off the mortgage. Any other debts are ignored, and it is just the value of the asset. So it is important, I suppose, to make sure that you meet that test. Now, obviously, you can combine any agricultural property you already owned plus the gift when you're looking at that 80% test.
But what would it apply to then, just for an example for someone? So it'd be a beneficiary who has other kinds of assets?
Yeah, so it's all assets, so even, for example, you need to take into account the value of a car that you might own, of your main home, any bank accounts, cash, all of that, and then any agricultural property. So, for example, if you had a small amount of land in your own name and say some farm machinery, tractor or other machinery, and then you received a gift of agricultural land from a parent or an aunt or an uncle, then you would need to look at the aggregate value of all of your agricultural property. So that was given in the gift that you received or you owned before, and then look at all your other assets. And as I say, it is about looking at all assets. So everything down to cash in the bank, cars, main home, savings, anything like that. And 80% has to be in agricultural property. Now, I suppose if you're married, there might be an opportunity, if you can't meet that 80% test, maybe before the gift takes place, to transfer some non-agricultural assets into your spouse's name so that you can meet the test. And so we would sometimes see people looking at that. I suppose that obviously you've got to look at that from a practical perspective. in a case of an inheritance, there's obviously not always the time to plan. Equally, if you have a mortgage on your main home, the bank may not consent to that property being transferred into one name. But where it's maybe possible to do that, there might be an opportunity to plan. So there, broadly, those rules for the beneficiary have remained unchanged. And probably two key changes that have come in the finance bill. One is that that active farmer test is now being extended to the disponer or the person making the gift or inheritance. So they now need to either be actively farming the land themselves with a view to making a profit. So they're spending 50% or more of their time carrying on commercial farming activities. Alternatively, they're leasing the land to an active farmer or a combination of both. And that is a 6-year test ending with the date of the disposal to whoever they're gifting it to. There is, however, transitional arrangements in place because these new rules only apply from 1 January 2025. So there will be transitional rules. So if, for example, you give a gift of farmland to a child, for example, in 2028, it's not the full 6 years then. Your 6-year period is deemed to be 1 January 25 to the date in 2028 that you gave that gift, because obviously that's when the new rules came into play. And I suppose the other main change is in the current agricultural relief section contained in the CAT Act, there's the ability to make a cash gift. So that's obviously a non-agricultural property gift to someone, subject to the condition that they invest that in agricultural property within 2 years. And then that qualifies for agricultural relief. The new section that's introduced in the Finance Act doesn't actually allow for the flexibility to make a non-cash gift. And the rationale behind that in the minister's speech was that he wants to make sure that agricultural relief is protected for people who are actively farming. And I think there might have been a sense that maybe some high net worths were using that section of the legislation as an opportunity to pass value to people at low effective rates of tax. So that will no longer be possible from 1 January 2025. And I suppose if we look then to say, well, the new rules come into play in 1 January 25, the old rules are in play up to 31 December. And if people are thinking about transferring agricultural land and they might be saying, well, what should I do? Should I do it before? Should I do it after? People might, I suppose, think, well, if they're not meeting that active farmer test and they're never going to meet it, because maybe they've inherited, for example, farmland from a parent before that now their child is farming, but they've never actively been farming. They might want to look at doing that transfer maybe pre-31 December in order for their child to be able to get the agricultural relief. Or alternatively, they might need to put a lease in place because if say, for example, they own land, then they've never been an active farmer, but they don't have any formal lease arrangement in place because their child is just actively farming the land, then they obviously won't meet the active farmer test themselves and they won't meet the condition that they're leasing the land to an active farmer. So they either might want to put a formal lease arrangement in place so that they will meet that condition post 1 January, or they look to transfer the land pre-Christmas.
So with the new changes that are coming in, both the person giving the land or property and the person receiving it will have to pass the active farmer test. And prior to that, it was just the beneficiary who had to meet the active farmer requirement. Okay, so that is a big change, I suppose, from January 1st. As you said, if there was an informal arrangement there where someone who was about to gift the property had not been actively farming and couldn't prove that they had leased it in some way, from January 1st, what happens then?
So from January 1st, they will technically no longer qualify for the relief. So I suppose they would need, if they're not actively farming, they obviously can't get themselves into that bucket. So they need to get themselves into leasing the land to an active farmer. So in that case, they would need to formalise their arrangement and put a lease in place to make sure that they can meet that condition. Or in the alternative, they look to do the transfer before 31 December of this year. And maybe, there are other things that can be put in place where maybe someone feels before Christmas of this year, in a little bit earlier than they might have transferred otherwise, but for this change in legislation. we can use things like farming partnerships to allow parents to retain levels of control and oversight until such time as the child is fully ready to take, full ownership and control. Well, they'll take ownership, but full control of the land. So there are, I suppose, mechanisms that can be put in place to manage that transition as well, not just for, I suppose, to maximise the tax relief, but also to make sure that the timing is right from a commercial perspective, because tax is important to everybody and nobody wants to pay more tax than they need to, but equally it should never be the driver of transactions. It's much more important that people are doing something for because it's the right time from a business perspective, from a commercial perspective, it's the right move from a family perspective, and then you look to do that in the most tax efficient way, but not letting tax be the driver in the first instance.
And sorry, now I'm asking you the most basic questions, probably, Alison, from your point of view. But if someone has not had a formal lease arrangement in place, a disponer, someone who's gifting the land up to this point, but they have to show that they were actively leasing or farming it for 6 years. At this point now, how do they do that? Before January, obviously there's not 6 years before January. So would they just have to put it in place now and not transfer it for 6 years?
No, the 6-year rule only applies from January.
Okay.
And so there are transitional arrangements in place that say that if you dispose of an asset between 1 January 25 and up to 31 December 2030, which is that 6-year period, that you're, for the purposes of satisfying that 6-year rule, you'll deem to be satisfied during that period. So, for example, if say you've got somebody with no kind of formal arrangement in place now, they don't want to do any transfer of land right now, and they enter into a lease, because it mightn't be necessarily just people who don't have have a child actively farming the land but don't want to lease it. They might actually be just renting it to another local farmer and intend to give it on to their children in the future. But just there's been a sort of a golden handshake type arrangement in place. Nobody's written anything down.
It's very common across the country.
Absolutely.
Yeah.
So now if they were to put that formal lease in place and make sure it's in place from 1 January 25, say then in 28, if they decide to transfer that land to a child, for example, they will obviously only have had 3 years of the 6 years, but under those transitional arrangements, you'll still be deemed to have met that 6-year test.
Okay.
So the key is really to get it in place before 1 January.
And then if they don't have it in place before the 1st of January and they go to February or March or the end of next year, and then they decide to put it in, is that relevant to them at all?
There could potentially be an issue then, because the legislation says that for the purposes of that 6 year, it's deemed to be that period from 1 January to the date of disposal. So you wouldn't have it for the entire period. So I would and obviously the finance bill is just at committee stage, or at bill stage. It has to pass through the various committee stages. So the exact wording of what's in the bill today may not be what's signed into law. But based on current drafting, I would recommend that any arrangements are put in place before 1 January, so that it's very clear for that entire period you met the conditions.
And this is an instance where someone might want to transfer later on, like 2027, 2028 and so on. But in the instance of someone suddenly, sadly passing away, again, is your recommendation, if you're healthy now and have plans for down the line, that you should work on them now and get them set up straight away before the 31st of December, so that everything is in train, God forbid something were to happen to you early next year.
Absolutely. I mean, people should always be making sure their will is up to date anyway. And if the intention is that you're holding farmland that ultimately will pass on to a niece, a nephew or a child, well, then it is important to make sure that they would meet the conditions for agricultural relief, because otherwise there is potentially the risk then that I suppose they may have to raise debt on the land or possibly sell off parcels of it in order to fund the CAT. And it is a very valuable relief. It is reducing your effective rate of tax from 33% to 3.3%. So I suppose where possible to satisfy those conditions, I think it's really important to do so, because there's a significant saving in tax.
And where should people go? I mean, I suppose there's people who have, as you said, had those sort of informal handshake arrangements in so many farms across the country. And as you said, sometimes they might be with neighbours, but eventually they intend to give the land to a family member who might be away working, in another job at the moment or something to that effect. And they don't understand what they now have to do. I assume it's going straight away to their tax accountant and try and get some sort of formal arrangement set up.
Yeah, exactly. So that their accountant or tax advisor can advise on that. And then for the drafting of the legal documentation, it really depends, I suppose, on who your advisor. So, for example, for us here in EY, we have a full tax and law service. So we could draft the lease agreements. We could update people's wills for them. Your accountant may not, have a legal arm to their firm. And so you may need to also bring in your lawyer as well. So it really just depends. But you will probably need a mix of tax advice and legal advice. We do all that in-house in our team, we both, but otherwise you'd need input for both, because you'd need to draft a lease agreement, and then also you just need to make sure there's no changes required to your will to make sure that you're getting the relief available.
I suppose inheritance tax is something that's just so topical at the moment, and we're on the eve of a general election in some ways, and people are talking about it at the moment. To not understand the changes that have come in Budget 2025 and to not close that window or that gap, from the 1st of January 2025, when these changes to the Agri Relief have come in, could have, serious financial consequences for someone. Like Agri Relief, reducing it, by 90% is such a significant drop in the tax bill that if they don't do that, and if they're not aware of the changes that are coming in, it really could have a financial impact on people if they don't have their I suppose, ducks in a row, Alison.
Absolutely. And I suppose the other thing, we've talked a lot about agricultural relief, which is obviously a relief from CAT for the children receiving, or not just the children, whoever is receiving the benefit. But we also need to remember that if there's a lifetime gift, so a farmer or an individual who owns farmland wants to gift land during his or her lifetime, they also need to think about capital gains tax. And there also has been some changes brought in both last year's budget and this year's budget in relation to capital gains tax retirement relief, which would also be relevant where the person wanting to transfer the land on is over 55. And in that case, I suppose it is important that we think about it from both angles, where there's like a lifetime gift, to make sure that not only is the child getting the benefit of CAT agricultural relief, but that the parents are getting the benefit, or the uncle or aunt, of CGT retirement relief as well. So I think it's really important, I think, that appropriate advice is taken. And also, I suppose both of these reliefs are going to have changes from 1 January 2025. And so there is a question of looking, I suppose, firstly to see, what is the right time for you? If we look purely from a tax perspective, is the timing Christmas because you're getting the benefit of the old rules and they suit you better? Is the timing post-Christmas because maybe the retirement relief changes suit you better? And then you need to obviously look at the commercial and family side, because we would always say, don't let tax be the tail wagging the dog. You have to do things because they're right for your family. You can always try and structure things in a tax efficient manner, but the key driver has to be the kind of family and the commercial side of things. But equally, these are two extremely valuable reliefs, and if the timing is right, and it's just a matter of making sure you're structured correctly so that you don't fall foul of any of the conditions, we would recommend strongly that you do this. Also, I suppose it's to be mindful that we are dealing for a lot of farmers here with agricultural property that they own in their own name, as opposed to, say, shares in a company that might be the case of business relief or other reliefs. So there's no point in going into your solicitor on the 15th of December to say, I want to do this because I want to avail of the agricultural relief changes that are in play today, when actually it just may not be physically possible to effect that transfer before the end of December, especially if, there's kind of things that they need to look at on the title of the land and all of that can take some time. So we just need to, from a CGT perspective, the date of the disposal is the date the contract is signed. But with the gift, it can be slightly different, and it might not always be possible to get that gift in before Christmas, depending. So I would say, if it's something that you're thinking about doing, act now. We're at the end of October, so really the run into Christmas is going to be very short time frame.
That's true. And just to bring it back down to a level that people might understand, when they hear CAT and CGT, and they might be like, oh, that's something, my accountant deals with. I don't know all about that. Like, to give an example of maybe someone that needs to think about when they want to transfer. Say you had a 67-year-old farmer, in terms of the retirement relief implications, and they want, maybe their land is worth a total asset of 3 million. What's the advice there in their lifetime they want to transfer? Should they transfer it then after January?
Sure.
Because at the moment they're capped, aren't they?
Yeah, so there's two key changes that have come in the budget across last year and this year to retirement relief. So just, I suppose, to recap, retirement relief is a relief from capital gains tax. So that is a relief for the person who's making the disposal. So even if you're transferring an asset to somebody for nil consideration because you're doing a gift, from a capital gains tax perspective, you're deemed to dispose of the asset at market value, and you pay your capital gains tax as if you did sell the asset for market value, notwithstanding that you've decided to give it away for free. Capital gains tax, similar to CAT, is at 33%. If you qualify for retirement relief where you're transferring the assets to a child, there is a full relief under current rules, uncapped if you're aged between 55 and 66. And then when you turn 66, it's capped at 3 million. For transfers to non-children, subject to some kind of minor exceptions, there is a €750,000 cap, and that cap reduces down to 500,000 when you turn 66. So if we look, I suppose, just maybe to keep it simple, at a parent looking to transfer farmland to their child, if they were, so that was the first. So the two changes that came in the finance bill, if I cover those first, was the cap, the age cap of the 3 million at 66, that age limit has been increased to 70. So now the cap of 3 million doesn't come into play until you turn 70 instead of 66. And that's relevant from 1 January of this year. Also, in last year's budget, they introduced this 10 million lifetime cap for any transfers between 55 and 69, whereas before that was unrestricted relief. That cap is still in place in the current finance bill, but it's giving the opportunity to defer the tax. So effectively, it means the child will never, or the parent will never end up paying the tax, provided the child retains the assets for 12 years. So if we look at, say, a farmer who is 67 and say that he has land worth, or she, land worth 4 million, for example, if they were to do that transfer between now and Christmas, because they're aged over 66, they would have a cap of 3 million. So the first 3 million of that farmland would be exempt from CGT, and the last million will be subject to tax at 33%. If, however, they wait until 1 January when the cap, the age limit for the cap increases to 70, because they're 67, they would now have they'd have the 10 million cap, but with the option to defer. So effectively then, for land of 4 million, that means they could transfer that in January completely free of tax. Whereas in December, they would have 1 million of it subject to tax. So it is important to look at the timing around when you transfer, from both a CGT perspective for the person making the gift and from a CAT perspective for the person receiving it, to make sure, are you better off to be in the old rules or the new rules?
It's definitely very important to look into the detail and see which is the most applicable for you in your situation. Absolutely.
Exactly. And because for some people, when we look at, say, the CGT retirement relief, if you're aged between that 66 and 70 age bracket and you've land valued over 3 million, you may be better off to wait until January. Equally, if you're somebody who has land that's of significant value and you're saying, well, look, I'd like to transfer it on to my children now, but who knows whether they'll, keep it forever or whether they'll continue to farm it. There's a normal 6-year clawback period for both the Agri Relief and for CGT retirement relief. But for land over 10 million for retirement relief from 1 January, that's going to be subject to a 12-year clawback. So maybe you might say, well, would I be better off to transfer before Christmas so that actually after 6 years, my kids have the flexibility if, maybe they're not able for the farming business or it's not a viable business for them anymore, that they have the flexibility to sell without suffering a clawback. So I suppose on the face of it, there is almost like a two different rules for both of the taxes and both need to be considered. So it is important that I suppose people just think about that and do that sooner rather than later, because as I say, we're kind of into the end of October now. There will be a little bit of timing around affecting any transfers pre-Christmas if actually it's more beneficial for you to do this before Christmas.
Yeah, I understand. And then I suppose just finally, before we finish up on our special episode on Agri Relief, if a farmer doesn't meet the conditions for Agri Relief, but they're registered as a farm business, is there other routes for them to claim any relief?
Yeah, if they don't meet the conditions for agriculture relief, and we often actually would see this because the beneficiary might fall foul of the 80% test. So you could have someone actively farming or leasing to an active farmer, but actually when you look at their assets, because maybe they have a family home and a car and,
maybe they have another family business or something that they're also doing at the same time. Yeah,
exactly. Or some money saved up and they don't satisfy that 80% test. And we can then also look at potentially claiming business relief. So business relief is a similar relief to agricultural relief in that it's also a 90% relief. So again, it reduces the value of the assets down by 90%. So in effect, your effective rate of tax goes from 33% to 3.3%. So very valuable relief. But business relief would have other conditions attached to it, but can sometimes be maybe a little bit more beneficial. So for example, if you were carrying on your farming activities through a company, you might be able to get business relief, or as I say, if you don't satisfy that 80% test. So there is the option to look at both reliefs and say, well, if I don't satisfy this one, could I satisfy the other one?
Absolutely. Well, I'm afraid that's all we have time for on this episode of AgriFocus. A lot to think about there for people and their own situations. It's definitely worth, as Alison said there, speaking to a tax advisor, whether it's EY or your own one in your local area, to decide what the pros and cons are, because everyone's situation is different and the timing for everyone is different. So it's really, really important to get the advice, but it's better to get it now because you have a small window of opportunity should some of the budget details be relevant to you between now and the end of the year. It's better to get the advice now so that you can get in there and take action now if needs be, or at least you'll have the information for next year. And that's all for AgriFocus for this episode. Please rate and review us on Spotify and Apple Podcasts or wherever you get your podcasts. And please do share this episode with anyone you might think will find it useful. Thanks to our guest tax partner with EY, Alison McHugh, for joining me today. Until next time, take care.
This podcast is sponsored by AXA Farm Insurance. AXA offers tailored cover to fit your unique needs, whether it's public liability or protection for your family home, outbuildings or farm vehicles. Based in Athlone, the AXA Farm team of agri-specialists and regional managers work together to ensure you receive the seamless support you need. Switching to AXA is easy thanks to an innovative online service that enables you to quickly and easily find the best cover for your needs. For more information, head to axa.ie. AXA Insurance Stack is regulated by the Central Bank of Ireland.